Don't put all of your eggs in one basket. If you drop that basket, you're out of luck. You lose everything in one shot. The same idea applies to investing, and that's exactly why diversification matters. When most people think about building wealth, they get caught up in the hunt for the right stock or the perfect investment. Maybe it's the hot tech company everyone's talking about, or a trendy new fund that looks unstoppable. But here's the reality. Even the smartest investors, with all the research and tools at their disposal, don't know for sure which investment will be the winner every time. Markets are unpredictable, surprises happen. That's why diversification exists. Instead of betting everything on one idea, you spread your money across different investments. If one area takes a hit, others can help balance it out. The goal isn't to eliminate risk entirely. That's impossible. It's to spread it around so no single mistake or market shock wipes out your entire financial future. So what is diversification? In simple terms, it means not putting all your money into just one type of investment. Instead of betting everything on one stock or even one sector, you spread it out across different kinds of assets. Stocks for long-term growth, bonds for stability and income, real estate for diversification outside the stock market, cash or cash equivalents for safety and flexibility. And here's why that matters. Different investments behave differently at different times. While one might be struggling, another could be holding steady or even growing. The mix helps balance out the ups and downs, giving you a smoother ride over time. Imagine you put your entire retirement account into tech stocks because they were booming. Then suddenly a tech crash hits like the dot-com bubble in the early 2000s, and your portfolio plummets 40% overnight. That's devastating. Now compare that to a diversified portfolio. You might still hold some tech stocks, but you'll also have healthcare, utilities, bonds, maybe some real estate in the mix. When tech takes a dive, those other areas can help cushion the fall. Your portfolio might dip, but it won't be wiped out. Instead of being forced to start over, you're still in the game because the diversification spread out your risk. Think about the 2008 financial crisis. Property values dropped sharply, foreclosures skyrocketed, and real estate investors were hurting. If your entire portfolio was tied up in property, you felt every ounce of that pain. But investors who were diversified, who also held stocks, bonds, and maybe international investments, saw their portfolios recover much faster. While housing was struggling, other areas eventually bounced back, balancing out the losses. More recently, during the 2020 pandemic, travel and hospitality stocks were crushed, while technology companies like Zoom and Amazon soared. Nobody could have predicted those swings ahead of time, but diversified investors didn't need to predict. They were already positioned across industries, so gains in some areas helped offset losses in others. The point is simple. No single asset class wins all the time. Markets rotate, industries rise and fall, economies shift. Diversification gives you a safety net. It doesn't eliminate risk, but it makes sure no single surprise has the power to knock you out of the game. It also reduces your reliance on one investment to carry your future. Your portfolio is built to weather ups and downs, so even if one area struggles, others can help keep you on track. Here are a few common mistakes I see investors make when it comes to diversification. Chasing winners. They pile into whatever did well last year, forgetting that performance rotates. What's hot today might be cold tomorrow. Thinking diversification means owning a lot of stocks. If all of your stocks are in the same sector, say tech, you're not really diversified. True diversification spreads out across sectors and asset classes. Ignoring international markets. US stocks don't always lead. At times, international or emerging markets outperform, and having global exposure can improve balance. Going all in on safety. Some people are scared of risk, so they hold only cash or bonds. That avoids volatility, but also risks missing growth. Diversification requires balance. Investing isn't just math, it's psychology. If your portfolio is concentrated in one area and that area crashes, panic sets in. Many investors sell at the worst possible time because the pain feels unbearable. Diversification helps smooth the ride. A 10% drop is much easier to stomach than a 40% wipeout, and when emotions are calmer, you're less likely to make rash, costly decisions in this way. Diversification doesn't just protect your money, it protects your discipline. Diversification isn't about owning a random mix of investments, it's about having assets that play different roles. Stocks are your growth engine, bonds provide stability, real estate can generate income and offer diversification beyond stocks, cash gives you flexibility when opportunities arise. Together, these create balance. Think of it like building a sports team. You wouldn't fill the field with only quarterbacks. You need offense, defense, and special teams all working together. That's what diversification does for your money. Here's something important. Diversification isn't about getting rich quickly. It's about staying wealthy over the long term. It's about resilience. Think about it. Compounding only works if you stay invested. If a concentrated bet wipes you out and you have to start over, you lose years of growth. Diversification makes it far more likely you'll survive the downturns and keep compounding through them. Now let's be clear. Diversification doesn't guarantee you'll never lose money. Markets go up and down, and no strategy can completely eliminate risk. But what diversification does is protect you against the unexpected. Instead of betting your entire financial future on one company, one sector, or even one asset class, you're spreading your bets across many. That means you don't have to be right every single time to succeed. If one investment stumbles, another can pick up the slack. Over time, the winners help carry the losers, and the overall portfolio keeps moving forward. Think of it like building a safety net. You're not relying on one outcome, you're building resilience into your plan. And that resilience is what helps investors stay in the game long enough to benefit from compounding, which is really where wealth is built. And that's really the secret. Not predicting every twist and turn, but having a plan that allows you to endure them. So here's the takeaway. Diversification protects you against surprises. Markets will always have ups and downs, and no one can predict the future. But by spreading your investments across different areas, you give yourself the best chance to grow steadily and avoid catastrophic losses. If this video helped you see diversification in a new light, hit the like button, share it with someone who needs the reminder, and subscribe for more simple strategies to protect and grow your wealth. And remember, investing isn't about luck, it's about balance.